Good afternoon, ladies and gentlemen. Welcome to the EENERGY Group PLC investor presentation for the full year results for the year ended 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Harvey Sinclair, CEO, and Rick Williams, CFO of EENERGY Group PLC. Good afternoon.
Good afternoon, everybody. So for those that are unfamiliar with our end-to-end strategy, EENERGY came to the market in Jan 20 to set out a vision for, I guess, the B2B sector, for both public sector and commercial, that would allow them to get to net zero without using their own capital. And we call this energy efficiency as a service. Our core business has been in the energy efficiency space, and more recently we have moved into a more end-to-end proposition through the acquisition of 4 businesses over the last 12 months. We're pleased to say that we've seen fantastic revenue growth of over 200% in the last year. 75% of that has come from organic year-on-year growth. We've registered our first maiden profit, 0.8 million, and we're in a very fast-growing and addressable market that's growing over 40% CAGR. So we're now in a position where our core proposition is about addressing energy wastage for both public sector and commercial businesses. And we've got a really seamless end-to-end solution now, which navigates customers in what we call the climate pathway. So we're really pleased with the growth that we've achieved in the last year, in spite of what has been a pretty challenging market. And I think the team has navigated the challenges of COVID remarkably well. And I'm really pleased with the outcome of where we've got to in the last 12 months. As a reminder, we've now got 4 key brands under the EENERGY banner. The first is obviously E-Light, which is our original business that we brought to market, which is a light as a service business, growing extremely strongly in both the UK and Ireland. And starting to branch out into the healthcare sector, as well as new commercial industrial subsectors. So really pleased with the growth in education, as well as emerging growth in the healthcare and C&I space. And then we've got a newly formed energy management division, which we are essentially transforming into an energy management as a service division through the acquisition of both Beyond and Utility Team. I'll talk about those shortly, but both businesses are very complementary. We're looking to rationalize those 2 brands under the EENERGY brand as we go into next year's first quarter. But the essence of that is a renewable procurement platform to procure and manage complex energy procurement solutions for the public sector, and also for large multi-site commercial and industrial sectors. The MyZero investment that we have made through the acquisition of Measure My Energy is right at the center of our strategy, and is now providing data analytics and consumption visualization of energy spend to our customers, and I'll talk about that shortly. This year has definitely been transformational. We've set out some pretty big goals at the beginning of the year, and I'm pleased to say that we've delivered everything we set out to achieve. We've transitioned from a pure play light as a service business into an integrated energy services company, addressing a very large addressable market. We've been able to scale organically, as I mentioned, and we've made some significant investments in technology that delivers efficiencies for growth in that energy efficiency business. We've successfully integrated the RSL business, which has given us a platform for multi-academy trusts in the education sector, and our pipeline of multi-site academies is growing very rapidly, and we expect to see some multi-site rollouts this year, which will be one of the drivers of that division. We've also integrated a number of back office technologies and platform plays across the Beyond business to enable it to be transitioned into the utility team business so we can leverage the platform we've got. And as I mentioned, we've launched a brand in My Zero to replace the old Measure My Energy brand, which allows us to offer data insights to our customers who are looking to identify where their energy waste is coming from and to really empower them to make more informed decisions around their energy efficiency strategies. I'll hand over to Rick just to talk about the revenue split, and then I'll recap on our strategy before we go into numbers.
Thanks, Harvey. Clearly, I will talk to the FY21 numbers themselves, but after Harvey's just outlined the strategy. But before doing that, just wanted to give a snapshot of what the group looks like today in terms of where the revenue comes from today on a kind of a pro forma annualized basis, including the acquisition of Utility Team, which as Harvey said, we completed last month. So by division, we generate 55% of our revenue from energy efficiency and 45% from energy management. So I think, clearly weighted towards energy efficiency. The business has moved in part because of the organic growth rate, in part because the acquisitions have been in the UK. Last year, we were 50-50 between the UK and Ireland. Now we are 6/7 in the UK and 1/7 Ireland. And I think that is likely to continue. And then finally, in terms of the industry split, 85% of our energy efficiency revenues in FY21 were in education. As I look at the enlarged group today, education is still the most important opportunity business sector for us. It's about 50% of our revenue, but we're well positioned in public sector and healthcare, and we'll talk a little bit more about those, as well as having a balance in the commercial and industrial space. So overall, what you can see is that the group today is now very balanced in terms of where the revenues come from and the opportunities, both in terms of sector and the services that we provide. Harvey, do you want to talk about the strategy then?
Sure, yeah. So what we've effectively built now is an end-to-end proposition for a customer that is managed by two divisions in our business. So we have the energy management division, which really provides three core services. The first service is access to the renewable energy market. It's actually access to the whole energy markets, but we make a strong emphasis to all of our customers that are looking to procure energy, that the strong recommendation is that they should only be considering the green renewables. And the Beyond platform is one of only a handful of platforms in the UK that actually allows our customers to tender their contracts into the open market and then see a transparent open bidding process where they're seeing open market pricing. You get that price tension, and then you see the full flavor of green, whether it's greenwash brown energy right through to nuclear energy, right through to the different types of renewable, pure, sustainable energy sources, and then a range of fixed and flexible products. So it really does disrupt the offer that our competitors are offering, in the sense that we're able to navigate a very transparent solution, and that's proving to be an extremely valuable tool within what is a very regulated public sector. So that's the core proposition, effectively, in the energy management, if you like, division. The energy management as a service transition that we're doing is to essentially sleeve our meter business, our smart meters, within the energy procurement contract, so that through a subscription model, our customers can subscribe to our smart meters that are linked to our analytics platform for a reasonably low cost entry subscription model that allows them to get absolute transparent energy consumption data behind their main meter. So what that allows them to do is identify exactly where they're consuming their energy, and it allows them to identify where they are wasting their energy. So if I give an example, with a school, 25 to 30% of a school's energy is still consumed when the school is closed. But without the ability to measure and track and understand where that energy is being consumed, the operators of that building cannot make behavioral changes in order to achieve any drop in demand. So this provides visibility, it provides data, a completely disruptive energy management solution to the market. More importantly, it provides then consultancy opportunities for our overall division to provide insights to that customer on how they can now reduce demand. And that then is a perfect segue into our other division, which is the energy efficiency division, which at the moment is principally offering 3 services. As I've discussed in the past, the first energy efficiency measure that any building operator should deploy, if they've not already done so, is a transition to LED lighting. It's one of the only energy efficiency measures that provides soft benefits. It's essentially good lighting drives good operating performance or good learning environments. And so switching to LED has a significant reduction in overall demand of electricity and provides a lot of soft benefits. After that, what we are now offering is what we call energy optimization. It's essentially turning dumb buildings into smart buildings. So using controls, using IoT, connecting devices so that buildings become smart, and then using effectively our smart metering and analytics platform, creating a contract for that customer that shares in the downstream savings below light as a service. So we've got a carbon waterfall slide in a second, which will demonstrate what that does. But this is a really significant added value measure that really drives a really strong return for our customers once they've done lighting. And that may include boiler optimization. It may include HVAC optimization, depending on the environment we're working in. So, for example, in the hotel sector or in the hospital sector, HVAC is a really significant draw on energy. And there's a 30% saving with retrofit HVAC systems that doesn't see the need to replace them, but just sees the ability to optimize the efficiencies. Think of it like an ECU chip in a modern car. It gets more performance or more efficiencies out of the building or the engine without having to upgrade the engine. And then the final piece, which is one of the most exciting growth opportunities that we're now really focused on, is how we can provide on-site generation to our clients with PV, i.e. solar, and therefore, as an add-on to that, EV charging solutions. We're in a energy environment at the moment where we've seen unprecedented energy costs. There are many reasons for that. We can touch on that at the end, but one of the reasons is the increase in carbon tax. And the increase in carbon tax is only going one way. And that increase in carbon tax is driving an ecosystem of higher energy prices. And so the only way really building owners and operators can reduce their carbon footprint and also reduce their operating costs is by significantly reducing their demand, i.e. energy consumption requirements. And the only way you can do that is by deploying the energy efficiency measures we've talked about. And our entire model is around funded as a service solutions where the subscription service the client's paying is always less than the savings that we're delivering. So taking that knowledge and that relationship we have with our customers on lighting and being able to expand it downstream. So hopefully that really does cover the next couple of slides. But I think in essence, it really does capture the journey we're taking our customers on. And if you look at, one of the really key drivers of why did we move into energy management? Well, in the world of energy efficiency, acquiring the customer is the hardest part of the, if you like, the customer life cycle. And by having a relationship with how we manage the energy procurement and the energy management of a client's procurement strategy, we've got an ongoing relationship with those customers. So to transition into a value add, drive down carbon, drive down energy costs, drive down operating costs for a business without the requirement for capital is such a powerful proposition that we're finding that those conversations are opening very fast indeed. And you'll see there, look, we've got 1,800 customers in the energy management division. We manage over 5.3 terawatts of energy. This is several billion pounds worth of energy through our platform for 1,800 plus customers. And all of those customers are motivated to reduce their carbon footprint and to reduce their energy costs and therefore their operating costs. So we have got a huge tailwind of high energy costs behind us. We've got a very large addressable market. We're trying to provide an end-to-end solution for our customers who don't have energy departments. Our customers, albeit have very large energy spends, but they often have very, very limited resources, who are experienced in demand side reduction, energy efficiency technologies, energy management, risk management, compliance around energy strategies. So we're a partner for our customers, aimed very specifically at a specific type of profile, which is public sector, multi-site, COVID resilient commercial industrial customers, who have all got a really big pain at the moment around the energy price market and how to get to net zero. So I've got a slide here which really frames what I've just described. We call it the Carbon Waterfall, and it's in a sense the journey we navigate a customer on. So this particular customer is a recycling company, 20 plus recycling sites, has a £2.4 million energy spend, very much a typical mid-sized commercial industrial client. And you can see here that on the left you've got this big block which is current carbon footprint, and on the right you've got the downstream activities that we're doing to reduce energy consumption and also therefore the carbon footprint. So for this customer, who was essentially a customer of another energy management procurement competitor, bought into our service because they recognized that horse trading around kilowatt price was not really the value driver in executing a strategy that was going to drive long-term value for the customer. What they wanted was a partner that could navigate them to green energy in a transparent way. So for this particular customer, they signed a 5-year direct agreement with ourselves as their energy consultant, where we would give them access to our platform and they would get open market pricing. We would drive down their carbon footprint by getting them to the most appropriate green, flexible, risk managed product that they needed in the market. At the same time, we embedded our sub-smart metering within their portfolio, and we did that at the same time as signing a LED lighting as a service contract. And so you can see that we, in those three measures, have been able to achieve a huge amount in less than 90 days. And on the right-hand side, you can see what the potential approximate value over a 10-year period is to us from a net revenue perspective. We're now in the fourth stage, where we're at the consideration stage of having done an assessment of all other energy conservation measures. And now what we will do as a result of having embedded our smart metering is we'll wrap all of those measures up, whether that's putting IoT controls in to optimize the way in which the building's consuming its power, whether it's optimizing their old HVAC systems, upgrading some of the components of their boiler system, and putting on some technologies that will optimize the way their compressors and pumps work. We'll wrap all that up, and what we're putting in place is a 10-year agreement on a share of savings model linked to the energy savings that we deliver, where we take 70% of the savings. Now, the customer takes if you like, a net 30%. They offload the risk management of the technology, of the installation, the ongoing operating management of any of that technology. And we have a long-term revenue stream that we'll collect annually as a result of the savings, okay? And that is a really good example of how we're capturing in one contract what I would call a multiple selection of energy optimization measures. And then in parallel, we're discussing with this customer as much on-site generation of PV on their rooftops as we can, in conjunction with sort of a starting position for all of those buildings with EV charge points. So we've taken this customer that would have perhaps been worth £400,000 to £500,000 over a 10-year journey in, if you like, the old business model, and you can see that we've got 4 times the downstream revenue opportunities over a 10-year journey. And that gives you an insight as to quite how exciting our opportunity is when you look at the customers that exist over beyond, whether that's multi-site councils, whether it's over at utility team with multi-site distribution centers, multi-site retail centres, multi-site hospital chains. These are large consuming portfolios that are we're a trusted partner to them, and they're motivated to drive down their energy consumption. So hopefully that captures the buy and build story that we've been assembling. We have a couple of small, if you like, missing chunks that at the moment we're working with joint venture partners on. So in the solar space, we're working with third parties. We think there is an exciting opportunity to maybe acquire a small bolt-on, fast growth solar solutions business to enable us to capture a greater share of margin. But we've got really strong demand in these downstream opportunities. And I think that's going to reflect the future growth of the business. In terms of near-term drivers, there's a handful of really big drivers at the moment. One is market demand for renewable energy. We're now at a point where nobody should be entertaining buying brown energy. It just does not make any sense at all. There's parity, and in some senses, there's actually a better value proposition in terms of price to go green than to go through the traditional brown energy options. Huge demand at the moment for energy data. Everyone has finally woken up that you can't manage what you can't measure, and everyone recognizes now that the only way to reduce their operating costs and carbon footprint is to reduce their demand. This concept of moving everything we do to as a service is being widely accepted across the world as the enabler of change as the energy sector becomes digitized and becomes a much more flexible, data-driven business model. In the same way that software took quite a while to get going with this as a service concept, when the switch happened, it was big and it was almost complete within a decade. We think we're right at the beginning of this journey where the energy markets are finally aware of the capital constraints of energy efficiency and the transfer of risk benefits of moving down a maintained as a service business model. So I think that they're really some of the macro drivers of the business. And then internally, we've got some fantastic digitization of our internal models. So, the development of our app to enable growth in the SME sector. What that really means is that we can handle smaller projects through third parties without having to invest the same amount of time in them. It means that we can touch more customers at the same time without increasing our, if you like, fixed cost base of customer-facing consultants. We've got this huge customer base, which is going to be the real focus now of all of our strategic account management strategies. And we've got back office integration efficiencies that our COO is putting into place, having invested heavily in the C-suite to enable these integration efficiencies to provide better products, better services with our sort of integrated companies. And finally, there's an obvious revolution happening with electric vehicles, with electrification of transport. Every building owner or operator needs to be able to offer some form of infrastructure to support that, and therefore they're going to need partners that can provide that alongside perhaps on-site generation.
Thanks, Harvey. Let's turn to the FY21 results, and I think I think standing back from it, we set ourselves some very ambitious targets, and we have delivered against all of them. We've delivered the strong organic growth. We've delivered our maiden profits. We've made 3 strategic acquisitions, which we have successfully integrated, and since the year end, we've acquired Utility Team, which we will talk about shortly, and specifically what that what that also brings to the group. I've got a slide in a moment on the financial highlights. I think from an operational perspective, we absolutely secured the leadership position in providing energy as a service and light as a service to the education sector when we acquired RSL in July. RSL was fully integrated into our operational platform and just reinforces that position that we've got in that marketplace. I think we've talked about the importance of the reverse auction platform and the technology that we've got within the energy management business, within Beyond, and how that drives our zero carbon marketplace and gives our clients the confidence of seeing a whole of market view around their pricing. And Harvey's already touched on the importance of having My Zero and the ability to measure and monitor and provide the analytics on energy consumption as a key step to identifying and then eliminating energy wastage. And in terms of the importance of the whole cross-sell and how we are bringing those services together, we secured our first, and the case study we talked to, our first combined light as a service and smart metering and analytics client in June, and that has now moved into being an energy procurement, an energy management client as well. And we have started to see the successful deployment of our light as a service projects into the Beyond clients, in the last month or so. So really very pleased with the results for FY21. If I move on to talk about the financial highlights, again, we've touched on some of these already, but revenue in FY21 is more than 3 times what it was in the prior year, at 13.6 million, and 76% of that has come from organic revenue growth in the light as a service business. And that has that organic revenue growth has come from a combination of delivering more projects. So we did 211 rather than 125 in the prior year, but also by those projects being larger. So the average size of project is more than 50% larger than it was in the prior year. So in terms of our margins in the business, okay, we've been able to drive the gross margin in the light as a service business up 360 basis points after commission expense to 34.5%. That is a combination of both improved funding arrangements for the Irish business, but more importantly, the relationship that we've got with our OEM supplier, who delivers to us E-Light branded technology that we install at a very competitive price. And that combination of the revenue growth and the improved margins is what's enabled us to post our maiden profits. So our adjusted Ebitda for this year is 0.8 million compared to a 1.5 million loss in the prior year, and that also translates into a profit before tax and exceptional items. From a working capital perspective, looking at the group as a whole, we finished the year with net cash of 0.8 million. Our light as a service model is cash generative, because what we do with our light as a service model is we are paid, we assign the contracts to our funding partners, so we get paid out at the beginning of the contract, and then we are typically paying our install partners and our technology providers after the installation. So we are paid within 5 days of installation on one of our projects, and we pay the month following to our supply partners, which is, gives us a very positive cash generation profile for the business as a whole, and that's what helps contribute to the net cash position, including accounting for leases under IFRS of 0.8 million. A lot of those financial highlights are really focused on the E-Light business and the light as a service business. Looking at the energy management business, we acquired Beyond in December, and in that time we've seen strong organic growth coming through Beyond as well. Because we haven't got comparative financials, I think the best way of capturing that is really the meters under management, and we saw a 9% increase in meters under management to just over 30,000 in the 6 months of ownership. So it has been absolutely a transformational year. We've delivered strong organic growth across the business. We've entered and diversified the model, entered new markets and diversified the model, as well as delivered our maiden profits in line with market expectations. And that is despite what we've faced into in terms of the global pandemic. So just to provide a little bit more data, a little bit more background on some of that growth. The revenue bridge here shows where that revenue growth has come from. So the left-hand side of the bridge is around the energy efficiency business, so that we have organic growth in both the UK and Ireland, And that organic growth has been complemented by the revenues that we generated through RSL. So we improved from 4.5 million of revenue in the prior year to 11.4 million of energy efficiency revenue in the current year. And I think, as I said, we acquired Beyond in December. So it's all comes through acquisition, which is what gives us our 13.6 million of revenue for FY21. If I now turn to look at what that means in terms of profit, last year, as I say, we posted a loss of 1.5 million at the Ebitda level. The impact of volume of that increased revenue that we've seen coming through the energy efficiency or light as a service business delivered an additional £2 million of profit. The improved margin, that 360 basis point lift, gave us nearly another £600,000 of profit. That puts us into a very strong position. I think it's been fair to say that the impact of the COVID restrictions in Ireland have been much more severe than they were in the UK, but we have managed the cost base in Ireland accordingly. We took the wage subsidies that the Irish government offered, and we managed the working hours and staff numbers for the team in Ireland. And as a result, we saved nearly £500,000 in terms of operating costs in the Irish business. Now, actually, we've still retained the ability to scale within the business, and so we're well placed for the year to come. I think in terms of the UK, we were investing in both incremental marketing, and we spent £120,000 of additional marketing in the UK, but also in our sales and operational resource, so that we're able to both acquire and deliver the additional volume of projects that we've seen coming through. And then finally, we've got the incremental head office costs. Harvey touched on the fact that after we acquired Beyond, we brought Rob in as our COO, and that's part of that investment in our group capabilities to help drive future growth across the expanded division. With Beyond's contribution of £700,000, that is what leads us to our maiden profit, our maiden adjusted EBITDA of 0.8 million for the year. So, Harvey, shall I talk to utility team?
No, I'll cover it. It's fine.
Okay.
So this is a business that was well known to us. The CEO, Delvin Lane, who's now our managing director for the energy management division, someone I've been working with and have known for over a decade from his days at Centrica when he ran that business, and then latterly Enesco. So lots of experience in energy services, who moved into being the chairman of utility team and then chief executive about 4 years ago, and really took this, what was a very, very strong and very successful energy management business, into a much more strategic energy consulting and strategic energy management business, focused much more heavily on large multi-site CNI customers. So it's a very, very well-respected business, has been growing at 24% plus over the last, I think, 7-8 years. It has a very strong CNI customer base, multi-site customers, strong healthcare, and what I call sort of COVID resilient commercial sector customer base. And it really does, I guess, pivot its strategy around the net zero strategy. It's a founder of the net zero standard, and the complements to the Beyond business were very evident from day one. They've got a very commercial focus, whereas Beyond had a very technical operations focus. And so we were looking for a partner that was going to complement the similar size business, and whereby there was a natural fit for the technology platform. So under Delvin's management, the plan will be that these two businesses will come together under the EENERGY brand in Q1 next year, and we will have the opportunity to leverage both efficiencies but also product offerings across the portfolio that will bring in stronger revenue growth and also more efficiencies. So a very well respected business with a very complementary customer base.
In terms of the financial performance of utility team, I think there's two things that I want to pull out here. Firstly, it's a well-established business that, as Harvey's described, but what we've seen is an acceleration in the volume of new business contracts that are being written in the business, and that reflects in a 26% annualized growth between 2014 and 2020. The step change that you see from 2017 to 2018 was part of a deliberate change of strategy. That is when Delvin joined the business initially as an advisor, then as chairman, before stepping in to take over as CEO. But there was a deliberate decision to focus on the larger, more complex contracts, which is part of the attraction for that business for us today. And that has been sustained through 2020, despite the impact of COVID. I think the second thing to pull out is that as I look at on the right hand side at how we present that in terms of the P&L performance, the business is these are the numbers that are presented under IFRS, so consistent with the EENERGY accounting policies. What we see there is strong growth in the revenue. That revenue reflects the accounting for the way revenues are accounted for in an energy management business is that the procurement element is recognized up front, and typically utility team are recognizing 20% of the value of the contracts up front, and then the balance of the contract value is recognized over the contract term. And so you can see the new business growth is driving the revenue that is being recognized in each year. But also you're seeing the improved profitability that is coming from the business. We have adjusted out for the unusual and non-recurring items in arriving at our adjusted Ebitda that we are presenting here. Most of those adjustments are around judgments around the revenue recognition, where we take a more conservative view than management had originally, but that conservative view will continue going forward. But one of the benefits of the revenue recognition and the accounting in the energy management business is that I can look and see a very strong order book. So I can see that we've got a forward order book today of over £10 million, which is booked revenue that will unwind over the next 2 years or so, which is the average contract length. And I can also see that looking at it today, I already have more than 2/3 of the FY22 revenues, that's my FY22 revenues through to June, already contracted and booked for the business. So really a strong position. The trading for utility team means that 2021 is going to be materially ahead of these 2020 numbers that are presented here. And actually the acquisition as a whole is going to be significantly earnings enhancing for EENERGY in the current financial year. Harvey, did you want to pick up on this?
Yeah, just to say that we've had a growth M&A mindset from day one. Okay, so we did set out our infrastructure and our management team with the intention that we would be doing a number of pretty fast-paced acquisitions and integrations. So what we are not is a consolidator. We're not a business that's just looking to add lots of the same businesses together, and we are quite cognizant of the risks that are involved in integration. So we've been very measured in our approach. The acquisition strategy around utility team from the very beginning was all around how would we collaborate and how would the fit with both people and systems come together. And we're very comfortable that the way in which we're going to migrate client data and leverage the best of breed from both businesses, utilizing, for example, the Coventry operations center will be where the majority of the delivery and service capabilities of the business are focused. And that's been at the center of everything we've been doing. We're looking to centralize our client acquisition strategies under a single EENERGY route to market. That's going to give us, over time, a number of economies of scale and more efficiency around messaging. We've just come out to the back of a number of education events in the last 2 weeks, which have been a real eye-opener because, as you can imagine, the events industry has been closed for the last 18 months. And before we went into lockdown was previously probably the most successful customer acquisition format we had. We've acquired more opportunities in the last 3 weeks than we have done in the last 5 months. And the event platform was centered around an EENERGY proposition, around the way in which we were enabling customers to get on that carbon waterfall journey that we spoke about. And so already we're starting to see that the blended combined offer that we have is much stronger than the previously strong single proposition with Light as a Service. So even where we are talking to customers in the education space, and in particular the multi-academy trust, which is going to be the real growth driver for this year, because obviously one customer who is a trust can have anywhere between 5 and 50 schools. Some of them had already done LED transitions, and actually where they were really excited was, what can we do next? We can't see the obvious next measures. And so after having consultations with those customers, we are receiving strong demand for appraisals around smart metering, around solar, around IoT. And so that really is helping. So that concept of an integrated brand and an integrated back office is already starting to come through. I think we're going to have a very sector-driven sales approach, and we're very focused in the fact that we think the public sector is probably the most powerful, if you like, sector that has the right, if you like, portfolio of needs, and we think that's going to be a continued big push for us. And I think obviously the metering platform is going to be at the centre of pretty much everything we do. I think just to summarize, transformational year, successful M&A delivery, both in the profile of the acquisitions and the strategic fit and the earnings accretion that we believe they are going to deliver. A strong platform for growth where we expect to be materially ahead of FY21, and with a tailwind of almost a perfect environment to build this business. So I hope that was useful, and obviously very welcome to talk about some of the interesting questions that have been put through the platform here.
Fantastic. Harvey, Rick, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Harvey, Rick, as you rightly say, I've had a number of questions come through during the event. We did have 2 pre-submitted questions, if I may just start off with those. The first one reads as follows: there seems to be a much lower acceptance of your LED proposition than one might have expected, given the zero setup costs and savings. Do you agree that this is the case, and why do you think this is?
So, look, I don't agree with that. I think we've demonstrated very strong growth in both the Irish market and the UK market, despite a number of periods of time where we were struggling to reach customers. So I think we're not seeing any slowdown in the appetite. I think our proposition has got much stronger, and I think now we've got a customer base that also has a number of rollout potentials that we will see, future revenue streams coming from. So I think we are very much seeing the growth we expect, and I think that we're at the beginning of the growth curve rather than at the middle or end of the growth curve.
Fantastic. Thank you, Harvey. The second one we had in reads, how does a period of higher energy costs affect the business?
So, if anything, we couldn't have asked for more, really, because as our customers face their renewal rates as they come out of old contracts, they're seeing a 50 to 100% increase in their operating costs and carbon footprint costs for running their existing building portfolios. So there are no cost savings to be had by buying differently. The only cost savings that can be delivered are through demand reduction, and the only way you can do that is by understanding where your energy wastage is coming from, and then delivering solutions to reduce that demand through energy efficiency. So it is the perfect storm. It is going to drive a more accelerated buying behavior of our story, and I think it's going to accelerate passive clients into active clients.
Fantastic. Thanks, Harvey. As you say, we've had a number of questions come through from the attendees for the live event. So if you may just click on that Q&A tab, and where appropriate to do so, if you could just read out the question starting at the top and give your response, that'd be fantastic.
Sure. Yeah, I might just start at the bottom actually and work upwards, just because I can see them now.
Absolutely.
So there's a question here about talking more about the potential solar acquisition and how that fits into our business model. I don't think we're a business that's set up to create startups from scratch. I think we can create organic growth strategies, but the concept of rolling through our customer base with a different solution, I think does require us to find a small bolt-on solar business that has got a growth mindset, that's got an appropriate valuation for the revenues and profitability it's delivering. And I think that there are a number of interesting players out there that have got the supply chain, the reference points, and again, it's one of the themes that have I think being asked here. Look, one of the defensive positions we have is that the number of referenceable sites and number of referenceable clients that we have acts as a huge barrier to entry, and also as a huge confidence booster for customers. So customers are quite nervous if you've not done, for example, a solar project before, because they want an experienced team that can specify the right solution and can deliver it within a non-disruptive, compliant and safe way. And so we want to hit the market as fast as possible. We don't want to go through a learning curve. So I think, I think the attractiveness of finding a strategically relevant and appropriately priced small growth business could be really attractive to shareholders, because we could leverage that and we could take out all the back office, absorb that, and then just drive it and accelerate it and provide the customers. There's another couple of interesting questions here around, can you provide EV charging solutions where grid capacity is under pressure? Absolutely. It is actually an area I'm quite passionate about. The weak grid is quite an interesting concept. There is a real vulnerability in our grid at the moment, and there's a real vulnerability of supply. And I think there is a really neat solution in what we call solar containers, or containerized solar solutions, where you've got the ability to effectively act as a backup supply for example, data centers or hospitals or schools, but at the same time providing a demand response to the own building platform, whereby you're driving energy into the storage containers, and where it's not being used through EV solutions, for example, you're then sending it back into the building, or you're receiving it to use in the evening when you've not got the solar. So we think there's a really interesting solarized container play that we're starting to work on. And that's going to be driven by a ban on diesel generators next year, which is going to really create a vacuum in the market for demand around backup supply for a lot of vulnerable buildings and a lot of vulnerable weak grid areas. There was another interesting question here, again about the high energy prices. Does it change the appetite of finance houses? We've not seen any evidence there's anything but an increased appetite for finance. We Rick and I are in the market at the moment, working with a corporate finance firm who specializes in Europe, in fact, global bankable energy efficiency, if you like, funding facilities. As you know, we have a really great relationship with a Swiss fund called SUSI that provide us with a committed facility for our Irish product projects. And that's been transformational in the way we're able to deliver solutions to the Irish market, increase our margins, and reduce the cost of serving those proposals. That is a model we're looking to replicate, and we have got really strong interest to provide a really large and diverse offering across not just lighting, but across everything we want to do in our energy ecosystem. There's a question here about, are we looking at behind the meter storage? So I interpret that as, are we looking at battery solutions to support solar and EV? I think the answer is no. And the reason I say that is because at the moment, I can't see in the traditional sense, outside of the containerized solar modules that I've been talking about, how there is a compelling model to build out sort of, if you like, a wholesale storage capacity for a client, unless there's a weak grid or there's a backup demand needed that they have traditionally relied on generators for example, hospitals, right? They can't go down, so they do need backup, and actually solar containers there is the perfect solution to wipe out the diesel generator market. But I think there is going to be a very interesting opportunity in time whereby customers that we have embedded a appropriately sized solar solution, and that's the thing. The solar business model is so compelling at the moment, subject to getting the scale right. So you've got to size it correctly so you can be sure that the demand of the building is at the right level for the production of that solar solution in the day. And if there is any oversupply, you can send it to the immersion heaters, which effectively treat hot water tanks as batteries, which is a really cool way for driving value in a primary school, for example. So we're working with some technology at the moment that can provide sort of like a module of solar, a handful of EV points, and a sort of a power diverter that can heat the hot water for when there's oversupply of solar energy. There's another question here. I'll hand over to Rick in a second, but in the government space, such as education, it looks as if you have to sell to individual schools. Is there any additional leverage you can get by approaching the education authorities? So it's a really interesting point, because historically, yes, we have historically gone after single schools in the independent sector, and we've started, as a result of the entry point that RSL gave us, we've really focused in on the multi-academy trust. And so I don't know whether you're aware, but the government is driving all schools to be part of the academy trust structure within a relatively short time frame. And so the MAT sector is rapidly growing. It's focused on sustainability. It's focused on efficiencies. And to just give you an example of how quickly we're scaling our pipeline in this area, we attended a keynote conference in Leeds over the last 3 days. I finished yesterday. We were a keynote speaker, and we've engaged with 30 multi-site, multi-academy trusts that have over 300 schools in their portfolio. And so that is one of the really interesting growth drivers. If we can build a strong relationship with a multi-academy trust, then we've got a more predictable, forecastable rollout strategy in the near term, 6, 12, 18 months.
Harvey, shall I take a couple of the focused questions? So there's a question around the phasing of our revenue and our revenue growth, in particular our expectations first half on first half. I think, as we have highlighted before, last summer, so the summer of 2020, we effectively enjoyed the benefit of, I guess, a COVID bump of projects that we would have expected to normally have installed in the spring of last year, which were actually installed in the school summer holidays. I think one of the impacts of COVID has been to, if you like, concentrate a little more schools projects into the schools holidays. We're starting to see that spread out again now, but that bump effectively meant that we had 1 to 1.5. I think I've estimated, well, I have estimated it at 1.2 million of incremental benefit in the first half of last year. If you strip that out, we are seeing underlying organic growth, and I think actually what we're expecting to see is the benefit of having the energy management customer base coming through the business, which, as I said earlier, we are starting to see. So yes, we did enjoy a benefit in the first half of FY21. I think we are, our trajectory is strong. There is a question in here. There is a question that has been asked about our WIP inventory. I think someone has obviously been looking at the balance sheet. Actually, the WIP inventory that we record in our balance sheet is those projects that are signed and are in the process of being installed. We typically install and complete a project within 6 weeks of the order being taken. So typically the month after the order, we will have completed the installation. So that is not really a measure of our pipeline. We have a number of different measures of our pipeline. So we have our order book, we have our WIP, but we are seeing very strong growth in our pipeline of opportunity. So I think hopefully that addresses that question too. I think there is, finally, on the financial questions, and Harvey, I'll pass back to you to wrap up in a moment. We have a question really looking again at the balance sheet and the balance between our payables and our receivables. Actually, the important thing for me is all of that. I described the working capital model for a light as a service project and the fact that we are paid out by our funding partners in advance. All of the businesses are profitable. All of the businesses are generating cash, and it's a reflection of the underlying model that they are cash generative businesses. So I don't think there's nothing to worry about in terms of the balance in the normal working capital between receivables and payables, and that's because we are collecting in advance of us paying our project suppliers and our technology suppliers.
Harvey, Rick, I think you've been fantastic in taking so many questions, and for everyone you answer, a new one seems to pop up. And of course, you guys will have the ability to review all the questions submitted by the attendees there. And thank you again for the attendees for submitting them. Just as we're coming up to the hour, Harvey, perhaps if I may just ask you just for a closing snapshot before I redirect the investors to give you some feedback.
Yeah, okay. So EENERGY is here to provide solutions to tackle energy wastage for the public sector and for the commercial industrial sector. We think that the energy efficiency as a service business model where customers can subscribe for energy savings, where the savings are always more than their fee, is a natural conduit for growth. And we think that we're well positioned to take a leadership position in the mid-market and see continued strong organic growth.
That's fantastic. Harvey, Rick, thanks again for updating investors today. Can I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of EENERGY Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.